Before we get started, just please understand that any advice in today's session is of a general nature only and that your personal circumstances have not been taken into consideration. Alright, so I was looking through some charts today and just having a look at what the market's been doing, what it has not been doing, and just going through some of my favorite strategies just to see what I could present to you today. And I noticed that the markets, when it goes into trend, there's been some trends development and reversal of trends. So I wanted to show you today a trend following system. It's a mechanical method. Some of you may have seen it before. The newer people in the room, perhaps this is the first time. I'll go through how to assemble the method, how to create the template, what to look for. We'll look at lots of examples. For the ones that have traded it before, it's an opportunity to ask as many questions as you can, just so that you can take the most out of today's class. Okay, so we're looking at a trend following method to trade. Our main goal is to identify a new trend and to ride that trend for as long as we possibly can. Okay, so the key being for as long as we possibly can. Now the time frames that I'm going to be working today, I'm going to be working with daily charts, but I've even seen variations of this with as low a time frame as 15 minutes, but the way that I'm going to show it to you today is try not to go with anything less than a 1 hour time chart. Okay, which market is it applicable to? Well, pretty much all markets. However, if you're going to look at, say, equities or an index market, if you're doing those, stay on a daily chart. Okay, the gap in nature of those markets will not really work for an hour. The indicators go a little bit haywire. So if you are going to look at those, just stick to a daily chart. Okay, so what indicators do we need? I need a variety of moving averages. I need a exponential moving averages, okay, at 8, 12, 24 and a 72. I need a fractal indicator and I need a commodity index, or otherwise a CCI, with levels drawn at the -150 and at the 150. So let me just build this for you right now. Some of you are a lot newer to trading, so I'll just explain how to do that, and then once you've done it once, you don't have to do it anymore. So just give me one moment. Let me bring on my chart and let me just randomly open up a chart. Here we go, and let's say if you open up a chart and it looks like this and you don't really like it, just right click, go to prop. I don't like the grid, for example, so I'll just get rid of the grid straight away. And then if you want to look at the candle colors and all those types of things, let me zoom in. So this is black and white. Right click, go to properties. In here, you'll see a bar up, bar down. So make all these black. Give me 1 second. My bear candle, I want, say, red. Yeah, my bull candle, I want it, say, green. As an example, let me just click OK, and you can see that I've already started to change it. Play around with that area, okay, but let's just say that's the chart that I want. I want to be on a daily, so there we are on a daily chart. Okay, so I said I needed a fractal indicator, so let me start off with that one. I prefer to pick up my indicators from the little green plus here where I'm showing. So I click on that, menu comes up, go to your Bill Williams folder, go across fractals. Pretty simple indicator. All you've got to do with this one is just choose the color. Now I've got a white background right now, so if I choose white, we're not going to see it. So let's make it, I don't know, purple. Click OK. Notice now that I've got all these marks on my chart, these little, so this is my fractal. What you'll notice is I have a fractal on most of my charts these days. What a fractal indicator does, it tries to point out like a low, a high, and a low, and if that happens, it will leave that fractal mark there, or if it's the other way, it'll leave it on this side over here. All right, it's actually a 5 candle sequence, but it's just easier to explain just as a 3 candle. Okay, so there you go. There's my fractal indicator. The next was moving averages. Go to my green plus sign. Go into my trend folder. Go across moving average. And the first thing it said, it has to be an exponential moving average. So here where it's got simple, change that to exponential. That's EMA. And now the numbers that I was looking for are, give me one second, I need 8, 12, 24, 72. So let's start off with the 8. Change that to an 8. And click, and leave everything else as it is. Click OK, there's the first line. Let's do it again. Now, once when you click here, the indicators that are listed here are the most recently used. So you can see that it's there, so I don't have to go through the whole menu again. 8, 12. I'll just change color. There it is. Do it again. 24. I'll change color again. Let's make it a dark blue. There it is. And one more time for a 72. And for the 72, I'm just going to make it the line a little bit thicker just so that I can stand that out a bit more. And there it is. Let me just double check that. 8, 12, 24, 72. Okay, so there's my moving averages. And the last indicator was a CCI with a minus 150 and a plus 150. Okay, so go to the green button again. My CCI I should find in my oscillator folder. Go across. There it is, commodity channel index. And go to your levels tab. And I think this is a default minus 100. So double click in there, change that to minus 150. Double click in there, change that to 150. Pretty much click OK and OK. And there is my CCI indicator down the bottom here. All right, once you've done that, you don't want to go through this process every single time. So pretty up your chart, make it pretty how you like it. Then you can right click, go to templates, click save templates, give it a name, click on save, and it will be there already. Okay, now I've already done it, so I don't want to save another version of it, and I'm just showing you how to create your template. So there you have it. Give me 1 second. I want to get rid of this chart now. Okay. All right. Next part. By the way, if you have any questions, if they come into mind, just type them in. I'll ask and I'll answer them as I see them. Okay. So we've got our template now. We're ready to use the strategy. So now we need to understand what the rules of the strategy are, how it works, and I'll cover these in detail. But here they are in written form so that you can take a copy of them and you've got them on record. All right, rule number 1. I need my exponential moving averages, the 8, the 12 and the 24 in particular. They must be in what I like to call perfect order. Okay, I'm only talking about these 3. They must be in perfect order. So what I mean by that is the following. So let's say if we're looking to buy, if they're in perfect order, they will look a little bit like this. I might have one moving average there. Let's call this one my 8. Then if I have another moving average, like this is my 12. And then I might have another one like this, and this is my 24. So they're in perfect order, meaning it's 8, 12, 24 in this order. Okay, so this is how I need them to be able to take to meet conditions number 1. And note, if I use a different color here, like anywhere through here, or if you can't see that, let me just change. If you see like down this dotted line, if I draw a dotted line across there, across that dotted line, they are in order. If I draw the line over here, they're not in order. Okay, does everybody understand what I mean by rule number 1? A lot of people get confused, so Can you just please acknowledge that you do understand, or if you don't, just put in a question mark. Yes? Thank you. All right, so that's rule number one. Rule number two. Rule number two says that the current candle must be closing above the 72 exponential moving average. Okay, so if I have my exponential moving average, my 72, like this, there's my 72, then my current candle must be closing above. So if the candle looks like this, did that candle close above? Yes or no? Okay, no. Good. What about a candle that looks like this? That's the one that we're looking for? Great. Okay, so this candle closes above. Now, what about sometimes you might get a candle that looks like this. Oops, sorry, I didn't mean to rub out the exponential. So the exponential is there. Sometimes you might get a candle that looks something a little bit like this. Give me one moment. Did this candle close above? Yes. Does rule number two say anything about the color of the candle, or does it just simply say that it's got to close above? Okay, so I'm just giving you a couple of little tips because some people get confused. Okay, the rule just says it has to close above. It doesn't say what color, and it doesn't say that it has to open below or anything like that. It just says close above. Doesn't talk about where it opens, just says close above. All right, so that's rule number two. Rule number three is the commodity channel index must be above the 150 level. So if I bring on a chart, and I'll just bring a random chart, and let's just focus on my commodity channel index, you can clearly see that in these regions over here, it's above the 150. Okay, everywhere else, it is not satisfying that criteria. Now, occasionally with this method, you get to a level where it's like right on, and there's going to be a little bit of tiny bit of discretion, and that's when you're going to have to make that little bit of discretion. Okay, but most of the time it's clear cut. All right, so there you have it. Any questions on anything that I've covered so far? All right, okay, so let me bring a chart now, and let me show you an example of where we have all three conditions on a chart. Okay, does anybody want to nominate a chart for me, something that they want me to look at? First person in. No? No one? Okay, well then I'll just pick one. Okay, give me 1 second. I'll just go with this one. That's right in front of me right now. All right, let me just scroll through to a clean example. Then I'm going to find variations on the examples, but I want to show you a clean one. Then we'll look for not so clean ones. Okay, let's have a look at this bit of graph, a bit of chart here. Okay, I am looking at, what am I looking at? New Zealand dollar daily chart. All right, so on my chart, just to clarify for everybody, that's my 72. This is my 24, my 12, and my 8. Okay, so if I'm looking at this bit of chart, rule number 1 said that the 3 moving averages have to be in what we call perfect order. So from this bit of chart, the first time that this occurs, to me it looks like it's happening just over here. Okay, right there, they're kind of crossing over each other. All right, where I've got the 24 at the top, the 12 in the middle, and the 8 down the bottom. So for me, from this point, I guess onwards, rule number 1 is being satisfied, because as you can see that they're staying in order all throughout this part, probably up until about here, where it looks like they're going to start to cross and start to get mixed up, spaghetti-like, as some people like to say it. But does everybody agree with me that from this first line A, pretty much they start to get in order? We all agree with that? Great. All right, so I guess rule number 1 pretty much comes into play from about there. Rule, let's look at the, this is a sell. Sorry, I should have done a buy. Give me 1 second. Let me find the buy, because I confuse people sometimes. Here, we'll just take this bit of chart here. Okay, from this bit of chart over here, the moving averages get in order around about there. Okay, so from there I've got you can see that the 24's there, the 12's in the middle, and the other one's over there. So from there onwards, they're in order. Okay, all right. The second part is, when does the candle close above the 72? Well, the first rule satisfies around about there, and from about here, every candle so far over here is closing above the 72. Every single one of them. Okay, so from about this point, that way, rule 1 and 2 have been satisfied. So then we go to rule number 3, which says we have to be above the CCI, the 150 level. Okay, now the 150 level happens here, 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 and here. Okay, so even though from this point that way, rule 1 and 2 are good all the way through, rule 3 is only good at specific points. Okay, so what we do is the following. Let's home in and analyze this little candle over here. Okay, so what I'm going to do, I'm going to put a vertical line through that candle. Let me just change that color. Okay, so I've just put a vertical line straight through that candle, and if we just analyze that candle alone, we can see that the CCI rule is met. That candle closes above the 72, so that rule is met, and the 3 moving averages are in order, so that rule is met. So what that means is that at that particular candle, everything is occurring. If I look at the candle before it, that one before it, we can see that my CCI is not at the correct level. Okay, so that would have been premature into the signal. All right, so does everybody understand what I've done to identify the signal? So the signal candle is this one over there. Let me just delete the line now. I don't need it anymore, and I've just left it in gray. So this here is my signal. Everybody's clear on this so far? Excellent. All right, so let me go back to the rules and let's see what happens when. So I've shown you how to identify it. Okay, so I'll move on. I'll come back to that one in a second. Okay, The current candle is referred to the signal candle. We just spoke about that, and we enter the trade on the open of the new candle. Okay, in other words, we enter the trade at the completion of that candle. So let me show you. So if this candle here, the one that's grayed out, if this, we only can lock in and say that it is the signal candle when the candle closes. Okay, so as soon as this candle closes, that's when we realize, yes, it did close above that level. We also look at the CCI, we say, yes, it did lock in, and we look at the moving averages and say, yes, they are in order. So when the candle closes, we have a trigger, and the rule says we open a trade at the open of the very next candle, which is, in this example, right there, and we open and we take a trade in that direction. Okay, now because I'm working on a daily candle, and currently right now during our winter, for me in Sydney, my daily candle opens at 7 a.m. So that basically means that I just need to look at my chart at 7 a.m., watch the candle at 6:59. I'll see the existing candle finish and close. At 7, the new one opens. I quickly check the candle that closed. Does it meet the criteria? The answer is yes. Bang, I take my trade and I'm in. All right, any questions so far? So everybody can see and understand how to enter a position. Great. All right, so now that I've got a position, let's see what it says. Okay, we are going to, now we enter the position, we set a stop loss 5 pips above or below, depending if I'm going long or short, the candlestick where the last fractal occurred, and then I will exit the trade using the fractal as a stop. So let me show you what I mean by that. All right, so we've established that I've entered the trade in that direction as such. Because I'm buying, I am looking at candles with a fractal at the bottom. So what I do is I go backwards to the candle that last had a fractal, which is this one here. I go 5 pips below. Now it's very, very important to understand that the actual little triangle is just purely a mark on the chart telling you that this is the candle that you're interested. So the level of where it's drawn is not important. Okay, so what I'd like you to do is whatever the low of this candle is, so there's the wick, whatever the low is, come down your 5 pips and then just place your stop right there. Okay, that's where your stop goes. Ray, I'm just a bit confused at what you're asking me. Can you just retype it for me, please? Okay, so that's the placement of the stop. Okay, the next thing that it said is, remember one of the aims of this strategy was to try and hit a new trend as quickly as we can, and then to try and stay in the trend for as long as we can. So we're using the fractal to manage our risk. So what that means is, as the trade starts to develop and move in our direction, whenever I get a candle, a new candle that has a fractal at the bottom, because I'm buying, I'm only looking at the bottom fractals, like here, what I then do is I grab the stop and I bump it to the next level. The trade continues, there's another stop there, so I grab it and I bump it. This one here, it's a little bit higher, I bump it. This one up here, I bump it until eventually I'm going to get stopped out at that point over there. Okay, and in this example, if we started the trade around about here, and we get out about that level there, that is 250 pips. Okay, is everybody clear on what we've just done? Okay, so that's, now I'm going to look at different variations. I'm going to look at things that to think about. For those of you who have traded the method in the past, there's an opportunity for you to ask questions that you will really only ask once you've actually traded it, okay? Because you're going to come up across situations that you go, oh, wait a minute, I don't know what to do in this particular case. All right, so to complete the exercise, let's cover a sell situation. For the sell, it's exactly the same thing. Everything, of course, just in reverse order. So we want the moving averages, the 8, 12, and 24. They must be in perfect order, but this time in reverse. All right, so meaning that this time I need my, let me try and draw this. I need my 24 at the bottom this time. My 12 above it, and my 8 above. No, sorry, I've done that wrong. Sorry. Let me erase that quickly. Give me 1 second. My pen is malfunctioning. Okay, so there's my 24, it's at the top. My 12 is there, and my 8 is down the bottom. Okay, so we need them in this order, so basically pointing down like that, and then that rule number 1's met. This time we need the current candle to close below the 72. Okay, again, just remember if that's my 72 there, it doesn't talk about, you know, where the candle opens or anything like that. So if we have a candle that it could be a candle that's red and opened below and closed below. So would that satisfy rule number 2, yes or no? Yes, it does. It satisfies the rule, so that's okay. If it opened all the way up here and closed like this, does that satisfy the rule? Yes, it does. Okay. So, and also if it happened to be a green candle that for some reason opened up here and then closed like that, does that satisfy the rule? Yes, it does. Good. All right. So, because we're going to see all these kinds of variations. A few questions are coming in. I'm not ignoring them. I will answer all of those in one moment. And finally, the last rule is we want the commodity index this time to be below the 150. Okay. So, and then we have the criteria that we're looking for. So let me quickly find an example of a sell just for the completeness of the exercise. I'll start on the same chart. We were looking at one originally. So here, let me find the one that I had. I won't do that one, I'll do this one here. Okay, so I want to focus on this candle here. If I look at that particular candle, I can see that one, it's closed below the 72 because it's closed down here. Okay. Two, the moving averages are in order, there, there, and there. And three, when I drop a vertical line, my CCI is below the 150. I'll just draw a proper vertical line for those that don't believe me. There you have it right there. Okay, so therefore that candle that I've just highlighted for everybody meets all of the criteria. It is a sell. So the rule says that I open a trade as soon as, or at the open of the very next candle, which in this case is right there. So I'm selling in this direction. So my stop because I'm selling this time, I'm looking at the fractals on top. Okay, so I go back and there's the last candle. I add the 5 pips and that's my stop. And then I'm going to use a fractal to manage my trade. So it starts to progress. I get another candle there. So then basically I move the stop to that level. I get another one there. Then I move it to this level. I get it down here, move it there, and then I actually get stopped out of the trade at that point there. On this particular example, this little bit of trade gets me around about 450 pips. Okay, is that clear for everybody? Okay, great. Let me just tackle some of these questions. A few questions just come through. All right, give me 1 second. All right, question number 1. How many pips does the broker take from trades overnight? Sanika, I think you're referring to swaps. Okay, so, and this is not what the broker takes. If you have an understanding of trading currencies, if you're buying, let's take the Aussie dollar as an example. Let's say it's the Aussie versus the US dollar as an example. If you're long, you're buying, essentially what you're doing is you're buying Australian dollars and you're borrowing US dollars. So the currency that you're purchasing in this example has a higher interest rate than the one that you're borrowing from. So you get a net effect that you actually receive a little bit of credit for every night that you hold a position. If you're doing it in reverse, you pay a little bit of credit, and there is no standard number. It's not like 1 pip or a quarter of pip or whatever. It depends on which currency pairs you're trading, and it depends what the interest rate on that particular currency is at that time. Like for example, the Aussie dollar just cut 1/4 basis points last week. Is that last week or the week before? Oh, I'm getting my weeks confused. So the number changes. Okay. So is that one clear? Okay, another question. Do you only enter the trade near the crossovers of the EMAs? Okay, so the question being asked now, the answer is, okay, the answer is that when you trade this method, if you trade it consistently and you, what you'll find is that you're pretty much going to be in a trade all the time. Okay, if you trade this method, you will find that pretty much you're in a trade all the time. All right, so, and if you're always trading it, you're going to pick up the trade the very first time that the conditions come across. All right, so you need to have a set of rules in your trading plan as to what to do when you get second entries. So I kept this bit of chart here because this is an example of that. Let's go back a little bit and let me focus on this candle over here. Okay, let me zoom in so we can make it a little bit bigger. Let's focus on this candle over here. This one right in the center of my screen right now. Now this particular candle, let's go through the rules. When I drop my vertical, my CCI is below, okay? The candle has closed underneath the 72, and also the candle, you can see that my moving averages are in order over there. So does this candle meet the criteria, yes or no? Yes. Okay. Oh, I've actually got an interesting question that just popped up related to this. Someone is saying, but the moving averages are not in order. Well, okay, so I take your point. So what that person is saying, John, is he's talking about all 4 being in order. Like over here, 72, 24, the 12, and the 8. See? 72, 24, the 12, and the 8. They're all in order. Over here, you got the 24, the 12, and the 8 are in order, but the 72 is out of order. Okay, that's correct. Now, the way that the strategy works is the 72 does not, listen, does not have to be in order. Okay, the rule says that it just has to close below the 72. All right, so this particular case over here is in fact a correct trade. Is that clear for anybody that may have had that question and didn't ask it? All right, so let me go back to the original question was, do I take the trade the very first time that at the start of when they on the moving averages start to fan out? The answer is, if you're trading this strategy consistently and always, pretty much as soon as you see it, you're going to take the trade. What's going to happen is, by the time we got the second entry over here, this is really the second entry, because if you were trading this all the time, this would have been my first entry. When you get your second entry, you now have to make a decision whether you want to add another position to your trade, or what are you going to do? Now remember, when your second entry comes along, you're already this much in the green, and your stop is over here. So you've already locked in profit. Okay, so when your second entry came along on this example, you're already 200 pips positive. So what do you do? And the answer is, you need to write whatever you're going to do into your trading plan, because this happens all the time. Okay, for me, for example, when I trade this method, if I get a second entry, I actually don't take any action, but it does give me a nice warm fuzzy feeling that there's still a lot of strength in the trend, because we got a second entry into the trade. And if we actually, let me zoom back out so we can see more chart. If we actually look at this, I get another entry there. I get another entry in here somewhere. And I get another entry over here somewhere. Okay, so if you have a look, I'm getting multiple. So if I was trading it from the beginning, I would have been in on the trade over there. Okay, and I just would have been writing it down and down and down and down. If I got it late, this is the second time, this is the third entry, this is the fourth, this is the fifth, etc., etc. One of the biggest things that you're going to have to deal with straight away is, if you all of a sudden decide that this is the method that you're going to trade, and you start to look at a piece of chart right now, you may have missed the first entry and you're up to the third entry or the fourth entry. So then you're going to have to make a decision whether you wait for the turnaround so that you can catch the first one in the other direction, or whether you want to participate and take advantage of it. Okay, has that answered your question, Romy? I think it was Romy that asked that question. Okay, next question. Sorry, there's quite a few questions coming through. Just bear with me. I just got to scroll back to catch them. Okay, I think that someone was asking, can I take second entries on the CCI? I just answered that. Calculate lot size as normal. Risk per pips. Lindsay, yes. The question, so what Lindsay's saying is, your risk level, whenever we talk about strategy, guys, your risk in terms of financial risk should remain as per your trading rules across whatever strategy that you're trading. So for example, if your trading rule said that the maximum risk that you will take on an individual trade is, say, $200, okay? With some strategies, the stop's going to be 40 pips. So therefore, how much is my dollar per pip risk? It'll be just $200 divided by my 40 pips, which means you can trade up to $5 a pip, which means half a lot as a rule of thumb, but some strategies are going to have a stop of about 200 pips, for example. So therefore, with that strategy, you have to trade at $1 per pip so that you can retain the original risk on the trade. Okay, so the answer is, Lindsay, yes, you still have to do your own risk management. Just adjust your trade size for the risk that you want to take. Okay, all right, and to finish off on this trade, if you actually took it from the beginning with this particular trade, you would have got stopped out for about 640 pips on the trade. Okay. All right, any other questions on this one? I just want to show you a couple and I'll analyze some charts. This is the US CAD. All right, US CAD, first entry in the downward direction is right here. This candle right there is my first entry. The three are in order. It's closed below and my CCI is below the 150. And if I was trading this, I would have just got stopped out at this level here just now for 535 pips, and the trade was as high as 1,000 pips. Okay, sometimes the frustration is that you just get stopped out and it continues down, but look, every strategy will have its frustrations, so you just need to see if this is a method that feels comfortable with you and that you like. The good part about this method is that it can be very minimal on your time. All right, so you can just log in once a day for 5 minutes, have a quick look at charts, make your trading decision, and then just close off and log off. If you log in and you have open positions, all you got to do is today the day that I move that stop, yes or no, and then you log off again. That's it. So it takes minimal effort. You can still run your business, do your job, do whatever you need to do. And what I generally find is the less I look at my charts, the easier it is for me emotionally for the trading. Okay, all right. So let's have a look at some live charts. Aussie dollar. Remember, just recently the Aussie dollar broke up. Okay, if we had picked up this method, picked up the trade right here on this green candle, and if we got it in, you would have got stopped out at this level here for 260 pips, and we were as high as 530. We got a signal in the other direction a couple of days ago here. That's a trade in the negative direction. This trade currently right now is up 113 pips. If you're trading this method, that's Aussie dollar. Let's move to Euro USD. Euro USD. Okay, okay, this is an interesting one. Euro USD. You would have got an entry here. This is the first entry after being stopped out. That's the first entry there, and if you did, and right now you're down about 29 pips on the trade. Now, one important point with this method is that it does allow you to take risk off the table. All right, if you entered here in this direction, your stop would have been there, and as you can see today or yesterday, we locked in. Now we can move our stop there, so a lot of that risk has disappeared. Okay, so and what you would be hoping for is that this kicks on into a really good trade. Okay, so there you go, US yen. Okay, I'm working backwards to see. These would have been borderline here. I'm not sure if you got stopped out there, but if it didn't, this trade kicks in up here. short Euro Yen, US Yen, short there. It nearly gets stopped out all these times, but it still holds on, and the trade's up about 600 pips at the moment. Okay, Euro Yen, let's move on. If you picked up Euro Yen, the last entry was about here, and you would have got stopped out over here for a loss of 44 pips right here. Okay, so for those of you that can't see it, so you would have entered here going short, your stop was up there, then it moved over there, then your stop moved down there, and you get stopped out there for a loss of 44 pips. Okay, I'm just looking at the charts that we always look at, just random. So that's Euro Yen, GBP USD, GBP USD. There's no signal. Here, this is a buy signal over here. And right now, you would be negative about 137, but you're still in the trade. US CAD, no signal right now. There's no trade. Aussie Yen, entry here, trades up about 113. Euro Aussie. Are you seeing how quickly I can scan through these? This is an interesting one, guys. Have a look at this one here. Focus on this candle here. It's a red candle. It's closed above. The 3 moving averages are in order. Okay, it doesn't look like it. It's a horrible looking entry, but they're in order. The CCI is above, so this is a valid entry at that level there to go this way. Your stop's there, and at the moment the trade is plus 560. Okay, and we haven't moved our stop yet. Kiwi dollar, final one. Kiwi dollar. Oh, Kiwi dollar, we got to sell 2 days ago. Okay, so Kiwi dollar, that's a sell. They're in order. It's closed underneath. CCI is good, so that's a sell. And if you took it, you would be minus 59. So if you take it now, you saved yourself 59 pips. Okay, so there you have it. Any questions before we wrap up for today? Any other questions? Oh, Alex, I get asked this question like a million times a week. Is this strategy back testable? Every strategy that is mechanical, you can go back test it by all means. Go for it. I've used it many, many years. Like some of you that have been with me for the last 3-4 years know this strategy quite well. It's quite a nice one from a mechanical point of view. Like every strategy, the secret to making a strategy work, a strategy is not going to work forever. I wish it did, but it's not the way it works. Certain strategies work better in specific types of markets. So what did I say when the class started today? This strategy is what? What kind of market do I need for this strategy to work best in? Anybody? A trending market. Thank you very much, Sanika. A trend following market. So if I see that the market is ranging, then this would not be a good strategy to use because I'm going to get stop, start, stop, start. When you backtest every data. Okay, so it's more important to say, does the strategy work under the correct market? All right, so it's a much better question, and the answer is absolutely. Okay, so what you'll find is sometimes when you come out of the noise, let me just find an example, give me 1 second. Okay, here's a good example. See here, this is all during that period there. It's to me, it's obvious that the market is kind of ranging, okay, but as soon as it comes out and starts to hit it, we can pick up trades. Sometimes what you do is you do get a signal inside the noise. So what you can do if you don't like it is you can skip the trade, but make sure that you include this in your trading rules. Okay. But once it comes out of the noise, that's when you pick up all your profits. Okay. The biggest trick here is that don't get out of the trade too early. Be patient with it. Okay. Like I've seen cases where you can pick up to 1,500 pips on trades. All right, so it does happen. You just got to be patient with the trade. Okay. Any other questions? The best filter to remove ranging markets is your own eyes. Okay, I don't trust any indicators. I just look at the market and I can feel when the market is ranging. It's just experience. You just got to trade lots and just look for zigzagging and things like that. And if you feel that the market is ranging, then change over to a ranging type strategy. Another question? Any value in Elliott waves? Which is the best wave to take the position at? Ray, I have a really good friend who's an Elliott wave trader. I argue with him all the time because he's never wrong. You know, when he is wrong, he says, "Oh yes, but that was really just cycle 2 of a larger time frame." And when he's wrong there, he goes, "No, but that was cycle 1 of a smaller time frame," etc., etc. So there's no. I don't like Elliott waves; they're just too complicated. It's trading should be easy. However, if it works for you and it's a method that you're congruent with, that is the secret. The method that you trade is the one that is the most comfortable for you to trade with. Okay, so that's my comments on Elliott waves, Ray. Any other questions? No? We're done? Fantastic. All right, guys. Well, I hope you have a great weekend. As always, if you're trying this method out and you're a little bit uncertain, take a screenshot, email it to me. When you email me, just respond back to the invitation email that you get on the day. That's the best way to get me. I'll respond back. And other than that, have a great weekend, and I will see you all on Monday. Bye for now.